If you've given trading a go, you probably found yourself jumping between different strategies, placing trades, and initially enjoying the excitement of the market. At first, it all seems intriguing and fun, and you might even make some money. But eventually, many traders blow their accounts. If you have gone through this phase and realize that you lack a profitable trading strategy, the next step is, of course, finding one that will actually make you money. The answer to your problems is actually right in front of you, and in your trades you are taking. Let me explain. One of the hardest things for a beginner to acknowledge is that their current approach may not have an actual edge. No matter how much you try to justify your losing trades by saying that you executed them slightly differently than planned and are blaming discipline and psychology, the hard truth is that there isn't real edge in the setups and you won't be profitable in the long run. What did I mean by saying that the answer is right in front of you? One of the common methods in proprietary trading firms of developing profitable strategies is by analyzing the trading stats around your trades. Yes, your edge lies in statistics. But don't get scared right away. It's not the statistics you encountered in your high school mathematics class, but your trading statistics. One of the key things prop firms teach new traders is to take as many trades as possible. They provide some basic order flow methods to help you get started, techniques that allow you to enter and exit positions efficiently. These methods give you an initial feel for the market and allow you to limit losses quickly if a trade isn't going in your favor. These are, in the most basic sense, scalping techniques, and there is a high probability that you have already developed your own just by being active in the market and placing orders. And why do they force you to trade? One reason is to develop feel for the market, and another, and in my opinion, the more important one, because it increases your chance of hitting onto something that might work. When you are just starting out, you should be shooting at every opportunity there is, having thousands of trade ideas. Maybe stupid ones at first, but that's part of the process. Having 100 trades per day just multiplies your chance for there to be one good trade somewhere in there. Statistical edge is developed through a large sample size. If you're only taking a few trades per week, you won't have enough data to determine whether your strategy has an edge. The more trades you take, the more data you gather, allowing you to analyze your performance effectively. One of the basic concepts you learned in your statistics class. Okay, I lied earlier about not needing to revisit high school teachings. One of the basic concepts is sample sizes. To have accurate data and statistically significant data, you need to have a large enough sample size. And this is definitely not 2 trades per month, or even 1 per day. Now let's rewind a bit. To do all of this right and get to something profitable in the end of the process, you first need to know the steps on how to approach those trades, or where the ideas should come from, since this is important as well. To develop useful ideas, you must start by forming a macro view or context on the instrument you trade. This could be based on macroeconomic trends, such as inflation or interest rate expectations, or a more technical approach, like market profile analysis. For example, if uncertainty around the Federal Reserve's future policies has heightened, you are safe to say this should be reflected in higher term premiums and Treasury yields, which means duration bonds down, yields up. Now you got yourself a view and know which direction to aim for. Once you have a market view, the next step is to use technical analysis to identify key levels where you should be looking for trades, whether long or short. Then, you begin executing trades around those levels while refining your strategy based on the market's response. In the earlier example, you find areas to look for shorting the 10-year Treasury futures, or going long the 2 to 10-year spread, or a number of different ways you can express your macro view you gathered. Now to the final part of actually finding profitable trading strategies. This is something you probably already know, but really holds its importance. These are the basic rules that you have most likely already heard of if you read anything about trading. Your winners should run longer than your losers. You hear it a million times, but you heard it for a reason. It works. If you're scalping and your average trade lasts a few minutes, your winning trades should generally last longer than your losing trades. For example, if your losing trades typically last 2 minutes, your winning trades should last at least 5 minutes. This principle also applies to profit and loss. Your average winner should be larger than your average loser. A common risk-reward ratio is at least 1 to 2 or even 1 to 3. If you're consistently taking 1 to 3 1 risk-reward trades, you're unlikely to be profitable in the long run, especially considering trading fees and commissions. I see a lot of guys doing these types of trades when they start. To help you out, don't do it. At that level, you are competing with high-frequency algorithms and infrastructure that costs millions of dollars. Another important aspect of trading statistics is ensuring that your biggest winner is significantly larger than your biggest loser. Your equity curve won't be a straight line. There will be ups and downs. However, occasionally, you'll catch a big trade that significantly boosts your P&L. You might be trading 10-minute time frames, but back to the principle of holding your winners, it might happen once you manage to ride out a winner for a whole day without closing. And you should never hold a losing trade that long, therefore, your largest winner should be disproportionate to your biggest loser. There are some other statistics that you should refine, like win rate percentage, percentage of shorts and longs, maximum favorable excursion, maximum adverse excursion, and so on. We will dive deeper into these in another video, where we show you a real-life example of a profitable trading strategy. All of the mentioned work can be done using a journaling software. You can do it manually in Excel, but it requires a lot of manual labor, and for the number of trades you will be doing, we do not recommend it. You should use the journal to categorize your trades by strategy, instrument, and type, whether mean reversion, breakout, range trading, or something completely different. By categorizing your trades, you'll start to notice patterns. Some strategies will show no hedge by the before-mentioned concepts, and you should start refining them or eliminate them completely. Others will show more potential, and you can refine them further. You might find that holding trades longer improves your P&L, or that certain market conditions favor your strategy more than others. Over time, you'll naturally reduce the number of trades you take daily. You might start with hundreds of trades per day and gradually refine your process to only a handful of high-quality trades that consistently generate profits. Developing a trading edge isn't an overnight process. One approach is to analyze past market data, test hypotheses, and refine parameters to determine what works. But another effective method is reverse engineering your own trading data, taking a large number of trades, analyzing them, eliminating unprofitable strategies, and refining those that show promise. If you follow this process consistently, you'll likely start breaking even within 6 months. Don't be discouraged if you don't see immediate results. Trading success takes time, and nothing happens overnight. The key is to review and refine your trades consistently. In future videos, we'll cover more details on reviewing trades effectively and improving your trading edge. If you have any questions or suggestions, let us know in the comments. And don't forget to like and subscribe, it really helps us out.